Hey there YouTube. So in this video I wanted to briefly cover taxes on U.S. source income for non-resident taxpayers. So if you're a U.S. resident taxpayer, that's you're a U.S. citizen, you're a green card holder, or you live and work full-time in the U.S., you know that you're subject to tax on your worldwide income. It doesn't matter what the source is. Now if you have foreign source income, you might be able to take foreign tax credits to try to help with the double taxation issue. But generally, you're reporting all your income and you're paying all taxes on it, right? That's the joys of being a U.S. taxpayer. Now, if you're not a U.S. taxpayer, but you're investing in the U.S. or if you have income sourced to the U.S., then you might be paying federal taxes on that U.S. source income. So I wanted to cover briefly what the main types of income are that you're going to probably be paying tax on and how you need to go about reporting it. So just to start with the definition here, a non-resident for federal tax purposes, again, it's a person who's not a U.S. citizen, they're not a U.S. green card holder, and they're not physically in the U.S. long enough to meet that substantial presence test, right? So the substantial presence test is basically if you're physically in the U.S. for greater than 183 days per year, there's an average computation there, you become a U.S. tax resident. If you don't meet that standard and you live outside the U.S., you're not going to be a U.S. tax resident. So what taxes will a non-U.S. taxpayer pay? Well, it really comes down to what is going to be U.S. source income. So there's a couple of them here, right? Taxes on U.S. source fixed, determinable, annual, or periodical income, or for short, we call it FDAP income. Now, the most common types you see are dividends, interest, and royalties. So this is, for example, let's say you're a resident of the UK and you open a brokerage account in the United States and you buy US stocks. If you're paid dividends from that US stock, that is going to be US source FDAP income, and it's generally going to be subject to withholding taxes. Okay, same thing with interest and certain types of royalties. Now the default rate for US source dividends paid to a non-resident is 30%. So if you're paid, let's say $1,000 worth of dividends from Apple, $300 is withheld and sent to the IRS as the tax, and then you get the difference, the $700 deposited into your account, okay? Now, the other thing that's really important to remember here is capital gains. So when you sell US stocks or bonds, the capital gains on the sale of those stocks are generally not subject to tax. And this is because it's not U.S. source income, right? The sale of stocks are treated as personal property. And when you sell personal property, the source of the personal property is the location of the seller, right? So it doesn't matter that it's a U.S. company. If the seller in this case is a U.K. citizen, so let's say they're living and working in London, they're a U.K. tax resident. If they sell U.S. stocks, that's the sale of personal property. The source is going to be the U.K. It's foreign source income, and you can find that in section 865A2. Okay, so that's briefly FDAP income, the U.S. tax issues for non-residents. Now, another type here is the tax on U.S. source trader business income, okay? So first is personal services, right? So if you are someone who is providing, let's say you're an employee or you're a subcontractor, you're performing services for a company. Personal services performed physically in the U.S. is going to be U.S. source income. So you have to actually fly to the U.S. to do the work on site. Let's say you're hired to do something on site for a week. That is going to be U.S. source income. It's U.S. source personal services income. You'll pay tax on it. If you are living and working outside of the U.S. while doing the work, that is foreign source income. Okay, and the reason for that is personal services is sourced to where you are physically present when doing the work. That's very important. What a lot of people mistakenly think is that, well, if I'm being paid from a U.S. company, then isn't that U.S. source income because it's coming from a U.S. source company? That is not the standard. If we look at 861 and 862, these sections in particular, you'll find that the source is where you are physically doing the work, right? That's what's important. So if you're outside the U.S. and you're working for a U.S. company, when you're being paid, that is foreign source income, so you're not going to pay tax on it in the U.S. It's only if you physically come to the U.S. to do that project. Another one that gets people trapped here is if you are an owner in a single member LLC, so you have a disregarded LLC or you're a member in a partnership, and that entity is engaged in U.S. trade or business and generates U.S. source effectively connected income, or ECI. In that case, because you have this U.S. trade or business and ECI, you're going to pay tax in the U.S., right? So for non-residents, we're looking at Section 871B. In both of these contexts, the non-U.S. person would have to file a Form 1040-NR, and if it's a single member LLC, they would report all of it on Schedule C, attach it to 1040-NR, pay the tax. If they're an investor in a partnership, they would use their K1, right? So they would report their K1 on their 1040-NR, report their net allocable share of the income, pay the taxes. There's also very likely going to be withholding taxes on the 1065, okay? And the last one, and this is kind of going hand in hand with the U.S. trade or business issue, but if you're a real estate investor in the U.S., so there are U.S. taxes on U.S. source real estate investments. That's if you're generating rental income from a property or if you're just selling the property. And this is even if it's just a personal home, right? So if you're a non-resident and you buy a home in the U.S. and you don't rent it out at all, you didn't even buy it for investment purposes, you just wanted a place to live for 1 month out of the year. If you sell it, that's U.S. source income, right? So the rental income is U.S. source ECI, and the non-U.S. person pays the taxes. So in this first bullet point here, you would basically be in the same position here. The non-U.S. person would file a 1040-NR, report the net rental income and pay tax. And then for the sale of the real estate, this is whether it's just a personal use home or an investment property, you have to be worried about FERPA withholding. So the sale of U.S. real estate that's owned by a non-resident is subject to FERPA withholding, which means that the broker withholds 15% tax on the sales proceeds, and it sends those taxes to the IRS. The owner gets the difference. Now, this is really important. The withholding rate is on the sales proceeds. It's not on the net gain. And so that's why this tax can be brutal sometimes. If you buy a property for, let's say, $900,000, you sell it for $1 million, your gain is only $100,000, but the broker doesn't withhold 15% on the $100,000. They withhold 15% on the whole $1 million sale price. So very often you can find a non-resident in a position where they're paying tax in excess of what their actual gain was. So there's a lot of ways to avoid these issues, FERPA withholding, ways to try to limit your U.S. source ECI. I'm not going to cover all those in this video because this is just a highlight of U.S. source income tax issues for non-residents. But if you have any questions about that, feel free to reach out to me, schedule a consultation. I help clients all the time set up structures to try to mitigate these exposures. So I hope that was helpful. If you have any questions, please leave me a comment below in the comment section there. Always happy to answer whatever questions I can. And of course, if you like the video, please leave a like on the video. And if you're not already subscribed to the channel, please go ahead and do so. And I hope to see you again soon. Thank you.